This is a download from BFM 89.9, the business station.
Now, good morning, Dodge. If I take a look at last week's performance of the stock market, it was a bit of a disappointment. It had the worst week since February. Now, that was rather surprising because it had all the right things going for it. There was a rally in oil, dovish statements from the Fed, there was a weak dollar, quiet on the Chinese front. So why do you think the stock market didn't bounce last week?
Yes, good morning, Melissa. Well, there are too many other factors to deal with that are producing day-to-day, persistent, if not consistent, uncomfortable lurches both up and down. One of the things that we've been watching particularly is the effect of negative interest rates on foreign exchange. For example, you look at China's currency, it's strengthened vis-a-vis the greenback, the U.S. dollar, but it's still weaker than when it was devalued from 6.20 to the dollar late last August. But the yen has gained on the dollar, and accordingly, it has also risen some 16.5% against the yuan. And it's a bitter pill for Japanese exporters to swallow. So there's a lot of concern and anxiety in the market. There's a loss of growth momentum. And in our stocks, yes, we've had some pretty good moves. 90% of our S&P stocks are above their 50-day moving average, which is really good short term. But if you look a little bit further out, half of those stocks are in medium-term downtrends, are still below their 200-day moving average. So there's really uncertainty and there's no conviction at this point. And if you look at the Dow rose 100 points plus in the advanced, but the advanced declines of the Dow stocks were actually negative. So it's not certain. There's a lot of uncertainty. There's no real direction at this time, and we're seeing the market reacting to news very short term, day in and day out.
Okay, so you mentioned the yen, Dodge. Now, how much of the yen's strength do you think came from the fact that the dollar is a lot weaker than what it used to be?
Yes, the dollar is weaker, and there's a lot going on the dollar side of currency swaps and currency exchanges. That is true. But the yen also has a life of its own, and if you take a look, it's not only against the U.S. dollar that it has the impact, it's also against China, it's against the euro dollar. So there is a lot going on, and really what's happening now is there's no real conviction one way or the other, and we're seeing a lot of swings very short term. So that creates a lot of volatility, which creates uncertainty, and it's hard to make a conviction move for the longer term unless you're willing to take some of the volatility and take the risk to the downside.
What are your thoughts on the dollar, Dodge? Do you think that the downtrend will continue?
Short term, I do think the dollar will continue. I think one of the good things is that the weaker dollar will provide support to industrial commodity prices, although concerns remained about the slow demand and oversupply of commodities, but I do think that will help. And I do think that there will be downside risks to the U.S. dollar as long as the downside risk to global growth implies that the Federal Reserve will proceed with caution in terms of increasing interest rates. So for the short term, I think there is still momentum to the downside, and I don't see that turning for another 3 to 6 months.
Are you acting on this short-term outlook, Dodge?
In terms of investments,
Yep.
Yes, we are. In terms of investments, there are some good long-term opportunities, Melissa, but one has to accept the volatility and that it may be too soon to buy, and yet one doesn't know. So if you take a look at the markets, what we're seeing now is that the long term is no better than neutral. The intermediate term still looks good, and the short term has been good, but it's now losing some momentum. We still there's some good opportunities. We're very bullish on gold. We're moderately bullish on energy-related issues. And we remain bearish on some airlines, autos, banks, brokerage houses. So there's more, the questions that we're asking and the opportunities we're seeing are more as a reaction to the short-term swings and not to the long-term potential, the long-term opportunities. And so it's very, very hard to make a longer-term commitment at this point.
Well, earnings season is set to kick off this week, Dodge. Which sectors have got your attention?
Well, Melissa, what we're seeing for earnings are expected to be negative earnings of companies listed in the S&P 500 probably will decline 8 to 8.5% for their earnings reporting for the first 3 months. Energy, once again, we expect that to lead the decline. We have some banks coming up this week, and we suspect that the financial sector will report 6 to 6.5% drop in EPS relative to a year ago. So what we are looking for is the reaction, first of all, of the most important thing will be the revenue growth, the expectations for revenue growth going forward, much more important than earnings per share. Secondly, we're going to be looking for the reaction to the earnings announcements. We suspect what we've been seeing, is the first move, the first reaction to earnings gets quickly reversed, even if it is in the direction of the earnings expectation. So if earnings are worse than expected, the market will take it down, but then it seems to bounce, and this is very hard to play. So what we're watching is for that second reaction and whether there's follow-through to that. So basically, bottom line, we're talking very, very short term in terms of earnings. We do not expect to be, the surprises are more likely to be negative because the expectations are negative, and even if they're better than the expectation, it still will be less than a year ago. So we're going to be very cautious going into this earnings season, and it's starting Monday night, 5 o'clock our time with Alcoa. It's always the beginning of our earnings season.
Yeah, so if earnings are in fact negative this season, this would mean the fourth straight quarter of year-on-year declines. What does that tell you about the stock market in general? Do you think there's a correlation between earnings decline and overall stock market performance?
Well, let's think about this. Earnings decline means the market needs some strength. It reduces the risk of the Federal Reserve increasing interest rates. So we're still in that mode of valuing stocks based on the perception of increasing interest rates. We haven't made the transition, which we've been talking for so long now, to transition to valuing stocks in the stock market based on economic growth and fundamental strength. We need to get there at some point. I suspect that we'll start to see that once again become a more positive question that we're asking rather than the negative implication that we're having now. But I suspect that will occur at the end of the second quarter, maybe the beginning, in the middle of the third quarter, and that's when I suspect that there will be a transition of the market to the more traditional way of valuations. But for now, it is a perception of a weak U.S. dollar, the perception of whether the Federal Reserve is going to increase interest rates or not, which is more likely at this point.
Dodge, always a pleasure speaking with you. That was Dodge Dorland, Chief Investments Officer of Landor and Fuest Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.